Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to CEO Shanker Patel and CFO Chris Day of Lords Group Trading, a UK specialist builders, merchants, and heating, plumbing products distributor. So, welcome, gents.
Thank you very much. Good morning.
Yeah, well, big congrats on today's Resilience 2023 results, with sales 2.8% higher to £462 million. But before we sort of dig into the details there, Shanker, I don't suppose you could quickly remind investors of the key USPs of the group, the sort of the secret sauce behind the magic.
So the secret sauce, it still remains the same. We've always talked about our equation that drives the way we operate our business, which is, EE equals HC equals SS. So that means an engaged employee or an engaged colleague equals a happy customer, and a happy customer means there's a satisfied shareholder. How we achieve that is through a decentralized model where we have great managers and directors, regional directors, divisional directors, all incentivized extremely well, but actually empowered to deliver the best that they can for the customer. And in return, we get rewarded through customer loyalty. And in return, you can see that our resilient numbers indicate that secret sauce, which is very simple, how it hovers around our colleagues and our customers, is the one that really is the key factor in our resilient performance.
Yeah, that positive culture certainly seems to resonate across the business. In terms of the sort of the consumer, the end sort of demand at the moment, Shanker, what are you sort of seeing? Because big picture, obviously, you have interest rates which are still quite high, but sort of projected by the market to come down. You've got the general election maybe in sort of 6 to 12 months, but most of the builders and the sort of the sort of construction industry are sort of like implying that it's tough at the moment, but should be better sort of like, tailwinds, hopefully, in sort of 6 to 12 months time.
Oh, certainly. And I think, the 12-month horizon is definitely positive, because we're off a, fairly low floor. And that floor was reached very swiftly. We all recall the house builders turning off the taps sort of June last year, and an almost immediate 40% decline in their output. And that can't be sustained. They can't sustain that output at that low level. But as the consumer starts to readjust to higher interest rates, I'm not saying that they're going to be as high as they have been in the last 6 to 9 months, but they'll certainly be higher than historic. We are seeing some adjustment, and that adjustment then feeds back into our markets, coming back to a more normal state. The next 6 months, I think what we'll probably see is a seasonally adjusted uptick. I think one shouldn't overlook the fact that this has been a fairly wet winter, so construction, by its very nature in this kind of climate, slows down. So agnostic of demand, it's just the ability for people to construct is impacted. We see that picking up as we get into summer and then autumn. So there'll be, in my view, just a normal seasonally adjusted pickup. But we're also seeing certain demand segments. Certainly, we're seeing regional house builders are starting to take a little bit more risk and go out there to start building ahead necessarily of a buoyant market. On the RMI side, we're starting to hear anecdotal evidence that trades are getting busier. It's getting difficult to get carpenters, landscapers, plumbers, all the sort of kind of trades that indicate the demand is starting to pick up. And we'll again see some of that come through in our like-for-like numbers. Sort of June onward last year was quite tough. It started becoming tougher and tougher rapidly. And we're hoping to see that from June onwards. And certainly we've had a decent run into spring, with April being quite positive.
It was pretty wet, actually. It was pretty wet actually here in Birmingham in April, but if you did pretty well, that's good. In terms of sort of like the timescales, what is the typical time lag between sort of like a mortgage approval or a transaction of a house and sort of like an uptick in sort of building products, and likewise with new build? What's just for sort of like to give people an indication of how they can sort of model it?
So the mortgage approval isn't exactly the marker for us, right? I mean, that's one of the ingredients that leads to housing transaction. But the point at which we can start to be confident about demand is following a housing transaction. And generally, what we say is between 9 and 18 months after somebody's bought a house, there will be some form of activity, and it could be as simple as redecoration, or as extensive as I'm building an extension, a complete house refurb, etc. So, and there are a couple of aspects to that. One is, most people walk in, the painting and the sort of small works are remedial repairs, maybe basic aesthetics. But some of the more intrusive work takes a bit of planning. And sometimes it takes actually a planning application. And we all know planning applications are quite difficult at the moment, not because it's difficult to get them necessarily, but the process of obtaining a planning application is much slower than it has been historically. And that's impacting our sector massively, right? There's an massive under resource in the planning departments. All the major house builders and anyone who carries out major development will attest to this particular issue, which is a bottleneck. It's a major bottleneck. But in the RMI side, not rampant that you need planning permission for the works that you're going to carry out. There, like I said, we see between a 9 to an 18-month period following the housing transaction, which means that the housing transaction levels on a monthly basis is a good indicator for us. And I think we're starting to see that start, progressing as we're starting to see the sales rates in some of the house builder numbers starting to come off their recent lows. How quickly that feeds into a buoyant market is dependent on other tailwinds, but certainly, as you've asked, that we should see the next 6 months start to indicate a much stronger market than the last sort of 9 months. If the truth be known, that's where we're positioning.
Good. Well, that's something to look forward to. Now, Chris, in terms of the numbers, I suppose you could quickly take us through the sort of the highlights, can you? Maybe a split between the two divisions, what you're seeing, and likewise sort of margins and cash generation.
Yeah, sure, Paul. So we feel Lords has demonstrated a really resilient performance in FY23 and has outperformed the wider sector despite the challenges that Shanker spoke about. And I think if you start with the foundation of that, it's the structure of our revenue base. So we talk about being highly exposed to RMI, which makes up 80% of our group revenues. And within that, 45% of our revenue is in the repair segment. So effectively non-discretionary, largely boiler repair and replacement. When you take revenue overall, we managed to grow last year, so 462.6 million in total, up 12.6 on the prior year, or 2.8%. If you look on a like-for-like basis, negative 1.2 overall at group level, but plumbing and heating up 3.7%, so kind of reflective of what I've just said around the non-discretionary element, but merchanting down 6.3% in a difficult sector and market last year. So overall, we're pleased with the revenue performance of the group. When you go to gross margin, we've actually improved our gross margin up to 20%, so up by 0.3%. I think that's a positive, but also reflected in the overhead base. So it's very much around the mix of business that we've processed in the year. Pricing action was strong to offset inflation. So we've got deflation in products and inflation in overhead base. So pricing's been quite important. And then a tweak in channel mix as the house builders have declined. That improves your gross margin because there's less direct to site work, but there's also more overhead because it's more expensive to fulfill. So broadly they're netted out really. Adjusted EBITDA of 26.8 million versus 30 in FY22, I think really reflective of what I just spoke about in terms of deflationary products, inflation and overheads. Additionally, as we previously guided, these figures are marginally suppressed. It's about 0.8 million of EBITDA by the loss-making Alloway acquisition that was completed in H2. So that will correct itself. There are five branches in strong South London markets, and will turn to profit over time.
And is Alloway now profitable? Is it now it's been integrated?
So it's integrated. We've taken out, we've realised the overhead synergy. Now got to build the revenue. and so it will through the year it will turn profitable.
Good. Can you just talk through the sort of the working capital? Because obviously you had a working capital unwind, which led to sort of like some good cash generation in the second half, particularly in that sort of the boiler or plumbing area, and then what that means in terms of the sort of net debt EBITDA ratio at the year end, looking ahead into 2024.
Yeah, so free cash flow generation overall was 13.9 million, or off EBITDA, just over 59%. We continue to manage the working capital tightly. That there was between half year and full year, you're absolutely right, there was a big inflow, but full year to full year, 0.8 million outflow. And I think it's typical to expect some seasonal movement in that working capital, because we effectively have forward cash flow in our plumbing and heating division, and as it's seasonally quieter in the summer, it's realistic to think that at half year you see a spike that falls away again at full year. In terms of net debt, it was 28.5 million on a pre-IFRS basis. That puts leverage at about 1.6 times. And I think kind of consistent with, as we've guided before, we maintain a medium-term target of less than 2 times. And I think if you move back up to the P&L, probably some bits that stand out around exceptional items, 2 points. One, stock adjustment, that's made up of 2 components. Unfortunately, we had an organised crime theft in one of our Scottish branches over the Christmas period. So absolutely a one-off, but quite a quantum, and therefore added back. And we've also revised our stock provision policy, which I think is a good move for the health of our working capital. It's historically been low, but it now is aligned to industry norms. The second point, which just ties the leverage together, is there's also aborted acquisition costs in our exceptional items. So we completed 2, Alloway and Chiltern, but we aborted 2, and the decision was made based on their trading performance. You know, Shanker's always very strong around maintainable EBITDA, and we had concerns over maintainable EBITDA facing into the more challenging markets in the second half of the year, and as a board we made the decision to exit/postpone those discussions.
Okay, good. Okay, well, Shanker, just in terms of sort of the next 6 months, whilst we sort of wait for the headwinds to sort of like subside and to the sunnier times before, how is the sort of business positioned in terms of sort of like its sort of strategy, sort of, you know, controlling costs, cutting, you know, improving efficiencies, also like to the big picture with M&A, and also can you talk a bit about the sort of the impact of the boiler tax from the government as well?
Okay. Oh God, lots of questions there, Paul.
I know. Sorry about that.
I'll try and unwind them one at a time. How are we positioned for the next 6 months as we start to see the headwinds turn into positive tailwinds? Very well. So, you know, this is a well invested, flexible, agile business with, you know, a massive degree of entrepreneurialism right at its core. I'd also add to that, we're actually very professional. So it's not just entrepreneurism, it's adding entrepreneurism and professionalism together. But it's a well-invested business. So whilst we all make a reduction in our overheads, we start to look into our businesses with a fine-tooth comb and try and eradicate anywhere that we've got excess costs or excess inventory, excess plant and machinery. We don't believe in cutting so much that it impacts our customer service proposition. That's the one thing that we're always very focused on. And on a sort of a monthly basis, we ensure that our capacity has enough spare capacity in the event that the markets pick up and we turn around and say, okay, we're too busy, we don't have the infrastructure. That's not going to be the case. We do, and even if the market picks up greater than our expectation, we're very quick to put the infrastructure in. Again, we're flexible, we're very agile systems and decision-making processes. So the next question was in terms of acquisitions, am I right?
Yeah, that's right, M&A, yeah.
M&A, I mean, look, M&A, we've always maintained discipline, right? That's the first thing I've always said is if you want to get into the business of buying businesses, after a while, especially if you're successful, hubris sets in, right? You think every business you buy is going to be great and you'll manage to turn it around. And there's certainly it's certainly a buzz around buying businesses and growing your business by acquiring others. But what we've always maintained is discipline. And that means that in markets where the overall market is challenged, so it's a challenging downward market, buying a business doesn't, is very challenging in that environment. So for us, our discipline kicks in, right? That's the sort of automatic defense mechanism that says, well, give us a fantastic reason to buy a business where potentially moving forward, the sales are going to be declining. The market is uncertain and declining. We don't have to, we've built our business to a particular scale where operational leverage exists so that when the market picks up, we'll naturally see the benefit flow through to the bottom line. And for a time being, for this point of discipline, we are not in the business of just going out and pursuing an acquisitive strategy just because we have done so in the past. The markets have changed, the environment's changed, and we have to adapt accordingly, which we will. That doesn't mean we won't make any acquisitions. We're just much more cautious in the current environment, much more selective, and the process by which we will make that decision is going to be that much more demanding because it's the risk that we take. I've always led the business to ask itself three questions when we're making these kind of investments. What's the upside? What's the downside? And can you live with the downside? And quite often people don't really focus enough on the downside, and that doesn't mean that you focus too much on a downside that is not credible. But if there is a downside and you can see all the downside scenarios being played out because you've got enough evidence, then you must ask yourself, can I live with the downside? And quite often you can't, right? And in that case, the upside's not good enough, not big enough for you to make that decision. So a simple rule like that will spit out a decision for us very, very quickly. Because if it's a great acquisition, the upside will be fantastic. And we'll be able to credibly say, well, actually the downside is limited. So therefore, it's worth doing this. In the current environment, I'd suggest it's going to be much more challenging to get the upside sufficient so that we make those kind of big decisions. So as I said, that's on the sort of more large scale acquisitions. If there are bolt-on small opportunities which fit within our financial profile, fit within our cash flow projections for this year, then we're certainly not close to that. That is what this business does. It is constantly evaluating opportunities, but it takes the opportunities at the right time, at the right price, for the right reason.
Yeah, those are pretty wise words, those, because I remember hearing Alex Ferguson one time saying that offense wins matches, but defense wins championships. And that gets you through that cold winter evening at 8 p.m., turning on the lights at sort of like down at Crewe Alexandra or something like that. So that makes a lot of sense. In terms of the boiler tax from the government, because they've obviously sort of done a bit of they still want to directionally help the industry move to heat pumps, but they've pushed it back, I think, 12 months.
Yes, I mean, look, it's a difficult debate for companies that are selling boilers to say that the tax or as it was termed, a levy, was something that was necessary. I think in the long run, in order to transition people from one fuel system to another, there is going to have to be some form of taxation or some form of levy, some form of financial penalty. The problem that occurred is that all of this was done overnight, effectively, okay, with very little guidance so that the industry could prepare. They put it through. It led to an issue where clearly the levy, the taxation, or the penalty was passed through to the consumer. We're now in a election year. You can imagine that probably is not going to go down very well. So it rapidly got unwound, but with the intention that it'll reappear in 2025. And some of those challenges that we faced will reappear in 2025. But perhaps I call it, we've had a dry run with a lot of disruption. I mean, of course, administratively, it's cost a lot. It also resulted in potentially the market being very buoyant towards the end of last year, and then, of course, falling off a cliff. And then with people now knowing that boilers, that the boiler levy is going to be removed, so they were probably held back in March, and we're now seeing again people coming back to normal in April and May. But I think, you know, leave aside the fact that the government intends to do this again, and the second time round we may or may not be better equipped to deal with it. I hope we will be. Certainly as a business we will be, because we spent an enormous amount of time and resource understanding the implications, reviewing what happened, and how can we avoid a operational and a financial impact next time round. But the sort of silver lining is the fact that it has got people thinking about heat pumps as a credible alternative to boilers. So without, in fact, implementing eventually the levy, I think the government have managed to get the heat pump market going, at least from the evidence that we have seen. We've seen some very strong increase in our like-for-like sales in the renewable sector. We don't see this petering off just because the levy has been removed. I think people realize that the levy will be coming back, and that actually this is now a committed and confirmed strategy to move the UK off of fossil fuel heating. The reason why I say it's a silver lining, because we're a distributor of heat pumps, and what we will benefit from in the future is that transition, right? They're going, you know, the manufacturers need us, the consumers need us, the government need us. We play a pivotal part in that supply chain to deliver a cleaner heating solution for the UK. And we will be ensuring that we invest, you know, a substantial amount of effort, not just cash in inventory. Some of that is likely to be cash neutral, because, you know, you're just transitioning from boilers to heat pumps, right? But it's more around the investment in the know-how, in the ability to sell that product, the ability to provide a solution to our customer. It's a little bit more complicated than a boiler, and certainly, you know, it reminds me, not that I was around at that time, but I can imagine when the boiler was first brought into the market, it was a substantial technological change in heating solution, and that usually leads to a lot of people, a lot of installers, etc., requiring technical knowledge. How do we fit this? You know, I've been asked to put in a heat pump. I'm not a heat pump engineer. So all of these sort of the push into this market will bring opportunities. And as I said, we're an entrepreneurial business. That's what we love. We love the fact that there is an opportunity, and that means it's a great place for us to start devoting our resources and making sure that we benefit from those opportunities that exist.
Good.
And
Chris,
growing.
Yeah, Chris, just in terms of that, the boilers and that switch from sort of like, you know, traditional gas boilers to heat pumps, etc. As that when the government has pushed it back by 12 months, that hasn't sort of like disrupted sort of your working capital, has it, in terms of holding which type of boilers and stuff, or has it happened too early?
No, it hasn't disrupted working capital. I think what Shanker said, what it has disrupted is customer behavior and kind of downstream supply chain. So forward demand in December, destocking in Feb and March, aggressive restocking in April and May, the first few days of May. I think it'll bed down in June, and we'll be back to normal.
Good. Okay, and then I don't suppose, Chris, you could just talk about sort of the outlook for the rest of the year, but more importantly, actually, sort of the light at the end of the tunnel when hopefully we see some of the headwinds turn to tailwinds in 2025. Just broadly, Chris, just in terms of the shape. I mean, obviously it's still tough sledging, isn't it, for the next 6 months, and that's indicated by the house broker sort of like, you know, numbers, etc. But I guess, you know, and I know there's no numbers out for 2025, but it's sort of like optically wise, if you start moving to headwinds to tailwinds, and the business has been controlling its costs, then we should start seeing, hopefully, and this is obviously indicatively, margin expansion and higher sales, I guess.
Exactly, yeah. But I think it's a FY24 as a moment in time. I think when you look back to look forward to normalized market, we'll see revenue upside. It's an operationally leveraged business, which means, you know, we can flex that fixed cost base quite strongly, and that will drop through into EBITDA margin. I think we've shown really good discipline in our pricing and our gross margin, so it's much easier to hold and refine that in a good market than a tough market, but we've done it in the latter. And then the business has a track record of investing in the right way, you know, whether that's CapEx across are people, plant and premises, or acquisitions where we get a 25% plus return on investment, but good track record of generating cash for either pulling down the debt and or investing in the group.
Good. Okay, and then Shanker, I suppose you could just quickly sort of like finish off with a sort of key message for investors. I'm guessing it's a matter of when, not if, in terms of sort of like the benefits of all the hard work that the company's been doing will be coming to fruition.
Oh, absolutely. Look, you know, as I said, we're a well-invested business in a cyclical market. I believe we continuously demonstrate a differentiation against some of our competitors. We are long-term in these sort of decisions and in the investments that we've made, knowing full well that in a cyclical market, you know, the downturn is fairly short and the upturn is fairly sharp when it comes through. The medium to long term projection for our industry is still very, very strong. In fact, despite the current outlook or the outlook for the last 9 months, you know, there is enough evidence out there to say that structurally the UK housing stock is underinvested, it's aged, the population is driving the demand for new housing, and you know, within 5 years, houses that were built 10 years ago require some form of repair, maintenance, or improvement. And again, we sit very well to benefit from that because we've got the geographical spread, we've got the teams, we've got the systems, the management capability, we're well stocked, well financed. So you're right, it is only a matter of time. And you know, our job is to make that when as soon as possible.
Yeah. Well, just as an anecdotal evidence, I mean, I'm going to be probably knocking on your door for a heat pump over the next 12 months because I've got to upgrade mine at some point in time. So I'll be down the local Lords, I think. Have a look.
I'll make sure we call you before you call us.
Okay, sounds good. Agreed. Okay, well, thank
service. Remember,
you can pop to Mr. Central Heating in Tamworth, Paul.
Yeah, that's a good idea.
Or West Brom.
Yeah, I think I'm probably one of the millions of property owners around the country actually who do need to upgrade their you know, sort of just houses and just look after it. Okay, well, thanks again, gents. Congrats on the resilient numbers, and really looking forward to presumably going to be an improving trajectory over the next sort of like 12 to 18 months.
Certainly.
Thank you.
Thanks.
Thanks, Paul.